$45,000. That single number just rewrote the entire EV investment thesis. Rivian's new R2 isn't just another electric SUV. It's a declaration of war on Tesla's most profitable vehicle. And if you're not paying attention to what this means for your portfolio, you're about to get left behind. Here's what I'm going to show you in the next 7 minutes. Why this price point is the key that unlocks mass market EV adoption, how Rivian engineered their way to margins that shouldn't be possible at this price, and exactly what this means for Tesla, legacy automakers, and your money. Let's get into it. First, why $45,000 matters more than any other number in the EV space right now. The average new car transaction price in America hit $48,000 last year. Read that again. The average. That means Rivian's R2 just slid under the single most important psychological barrier in automotive retail. They're not asking you to pay a premium for electric anymore. They're asking you to pay less than average for a vehicle that costs almost nothing to fuel. But here's what most people miss. This isn't just about consumer psychology. It's about TAM, total addressable market. Below 45,000, you unlock 62% of all new vehicle buyers. Above it, you're fighting over the wealthy 38% that every luxury brand is already targeting. Rivian just went from niche to mass market with a single announcement. Now let's talk about how they got here, because this is where it gets interesting for investors. Pattern interrupt. Forget everything you thought you knew about Rivian's cost structure. The old Rivian, the R1T and R1S Rivian, was bleeding money on every vehicle. We're talking negative gross margins that made Wall Street analysts physically uncomfortable. The R1 platform was over-engineered, over-featured, and frankly, over-budget. The R2 is a completely different animal. Rivian built this platform from scratch with one obsession: cost per mile of range. They stripped out complexity, smaller battery options, simplified manufacturing, a factory in Georgia purpose-built for volume, not handcrafted luxury. The result? Rivian is projecting positive gross margins on the R2 from day one of production. Let that sink in. A startup EV company achieving what took Tesla nearly a decade to accomplish with the Model 3, and they learned directly from Tesla's mistakes. Same LFP battery chemistry that made the Model 3 profitable. Similar casting techniques that reduce part count. Even the factory layout mirrors the efficiency gains Tesla pioneered in Shanghai. Rivian didn't just build a cheaper car, they built a money-printing machine disguised as an SUV. Now, here's where we need to talk about the elephant in the room. Tesla. The Model 3 has been the undisputed champion of the affordable premium EV segment since 2017. 8 years of dominance. But that dominance was built on one thing: no real competition at the price point. The R2 changes that equation permanently. Look at the spec sheet. Similar range, similar performance. But the R2 is an SUV, the body style that Americans actually want to buy. 60% of all new vehicles sold in America are trucks or SUVs. Tesla's answer, the Model Y, starts $5,000 higher and just got a refresh that Wall Street called underwhelming. I'm not saying Tesla is dead. That would be ridiculous. But I am saying their market share in the $40,000 to $50,000 segment is about to face pressure it hasn't seen since, ever. And Tesla's response tells you everything. Price cuts in Q1, more price cuts likely coming, margin compression across the board, Elon talking about robo-taxis because the car business is getting harder, not easier. Pattern interrupt. Here's what Wall Street won't tell you on CNBC. Institutional money is already repositioning. In the last 60 days, 3 major funds increased their Rivian positions by double digits. Meanwhile, Tesla's institutional ownership has quietly declined for 4 straight quarters. This isn't retail traders on Reddit. This is BlackRock, Vanguard, State Street. The smart money doesn't announce moves, it makes them while everyone else watches the headlines. The R2 reservation numbers tell the same story. Over 90,000 reservations in the first week. That's not curiosity, that's commercial intent. At $45,000 per vehicle, that's over $4 billion in potential revenue sitting in Rivian's pipeline before they've built a single unit. Now let me be clear about the risks, because I don't do hype, I do analysis. Rivian still needs to execute. The Georgia factory isn't producing vehicles yet. Supply chain constraints could delay timelines, and the EV market is getting more crowded, not less. Chinese manufacturers are circling. Legacy automakers are finally waking up. But here's my take. The risk-reward on Rivian just shifted dramatically. 12 months ago, this was a speculative bet on a company burning cash with no clear path to profitability. Today, it's a company with a credible product, a credible price point, and a credible timeline to positive margins. Is it guaranteed? Nothing is. But the asymmetry is compelling. So here's what I want you to do. If this analysis helped you see Rivian and the EV market differently, hit subscribe right now. I break down moves like this every single week before they become obvious to everyone else. The subscribe button is free. Missing the next opportunity isn't. I'm Brian Justice. I'll see you in the next one.